Tonight we're going to talk about savvy cash flow planning and how to get the most in retirement, because really cash flow planning is probably the most important thing in making sure your money lasts longer than you do. And there's a bunch of different ways to go about it. So we're going to talk about some of the strategies related to cash flow planning. So what we're going to talk about first is just kind of the retirement journey in general, the sections of the journey. Then we'll talk about some of the risks, because there's a lot of large, significant risks in retirement that really aren't that big of a deal while you're, pre-retirement and you're still accumulating. And there's a lot of unknowns around those. So we'll talk about those. Then we'll talk about the cash flow strategies that we can use to minimize some of those risks and make sure your money lasts. Then we'll talk about some other ways to increase cash flow. Whether it's getting the most from your Social Security and deciding when to turn the benefit on. Should you delay it? Should you take it early? We'll talk about tax diversification, because one of our main mottos at Anchor Bay Capital is that it's not what you make that counts, it's what you keep. We focus on, if we could save you money on taxes, that's just as good, if not better, than getting you extra investment return, and it just adds to more money in your pocket. And then finally, we'll just talk briefly about the various ways you can use home equity in retirement and increase your cash flow. And this will be a topic of a presentation, a deeper dive that we'll do probably sometime in October, where we'll get into all of the options for home equity. And then we'll open it up for any questions you may have. We can use the chat function, and you can submit your questions. And then certainly if you want to ask your questions after the fact, you can always just reach out to me personally, email or phone call or whatever. So let's get started. So the way we kind of like to look at retirement is that, it's a journey. It's like climbing a mountain. And there's two phases to this mountain climb. First is going up, or accumulation. So before retirement, you're just trying to save as much as possible and get up the mountain. Ultimately, you'll reach the peak, and that could be a certain age or a date or milestone or whatever, before you decide that, hey, I've made it. Now it's time to retire and take it easy, or do whatever it is you want to do in retirement. And then you've got to start coming down the mountain, or distributing your money. The paychecks have stopped, and now you've got to use the money that you built up while you were going up the mountain. And that's the kind of the riskier phase. So, going up is pretty easy. As an advisor, our focus is just helping you grow that nest egg. Making sure you're putting as much money away as you can in your 401k or other tax vehicles. Ideally, we're creating tax diversification, so you've got money in a bunch of different buckets rather than just all in the retirement plan. And so, it's just slow and steady. Just keep pushing you up the mountain and towards that goal, whatever, that goal is. And then it's focusing on proper asset allocation. Make sure you're invested properly so that, you're growing the nest egg as much as you can, but at the same time, you're not subjecting it to a large risk that you're not comfortable with. Ultimately, you'll reach the top of the mountain, and this is a picture I use in my Social Security seminars. So this is Mount Whitney here in Southern California, in the Sierra Nevada, and this is myself and my son Brandon on it. I've done it a few times, but this was a trip a few years ago that I was able to do with my son, which was kind of cool. So you can see Mount Whitney from the front there. It looks pretty imposing. It's steep, but the reality is there's a trail to the top, and it's a hike. It's 22 miles round trip, and you are at 14,500 feet, so the air's super thin. And so it's one of those bucket list things people like to do. The reason Mount Whitney's important is it's the highest mountain in the continental United States. So outside of Alaska, it's the tallest mountain in the country. And so it's one of those bucket list things, and I've been able to do it a few times. So this picture with Brandon was taken in September, and you can see there was already snow on the ground. So, there's a lot of unknowns when you're out there climbing mountains. A lot of things could happen. You could slip and fall. You could have a snowstorm. You could get lost. There's all kinds of risks. And so, getting to the top is only half the journey. And this is Mount Everest, which is actually twice as high as Mount Whitney. And there's been a ton of studies that have shown that about 80% of all climbing injuries and death happen on the way down. And why is that? Well, you put all this effort into getting to the top of the mountain, and so you've reached your goal, and so there's the adrenaline rush wears off, and as I mentioned, it's only half the journey. You still have to come down, and at that time you're tired, or on something like Mount Everest, you maybe are running low on oxygen. A storm could come in. There's a bunch of reasons, but a lot of the accidents happen on the way down. And it's the same for retirement, for your finances. The distribution phase or retirement phase is far more financially risky phase of life. And there's a bunch of reasons we're going to talk about what I call the big 5 risks, but also because if you're in retirement, unless you've retired early or something like that, there aren't do-overs typically. You may have retired because you've been job eliminated or for health or disability, or maybe, you just decided to retire, but it may not be that easy to go back into the workforce if you can do it at all and just continue with your life as it was. So once you started down the path, there often isn't an opportunity to recover, or if you do have an opportunity, it's, maybe not going to be as easy to accomplish as going up that mountain. So let's talk about these retirement distribution risks, and we're going to talk about how cash flow planning can help minimize some of these. So these are kind of what I call the big 5, that you have these risks while you're accumulating your nest egg, but they're not as big a deal because you've got time to recover from them, and you also have your goal in mind. When you're coming back down the mountain or you're in retirement, these have an impact because you may not be able to recover from them. In addition, coming down the mountain, you don't even know how long the trail is. If we know going up, hey, I'm going to retire at 65, 67, 62, whatever, we've got an end date in mind that can be adjusted. But going down, you don't know. You don't know if you're going to live 10 years, 20 years, 30 years. If you're married, you don't know how long your spouse is going to live. So it very well could be that you got to plan for 30 years or so in retirement, and all of these risks can have a big impact. So when we're working with retirees, what we're focused on is preserving that nest egg and asset distribution or cash flow planning to make your money last as long as it possibly can. So let's start with tax risk first. So when I'm doing these in person, I typically ask this question, do you think taxes are going to go up? Do you think they're going to stay the same? Do you think they're going to go down? People will raise their hands for each of these. And we've got an election coming up in, less than 2 months now, which could have an impact on taxes. Do I know whether they're going to go up or down? No, I don't. But what I do know, just from experience, is that tax rates change about every 4 to 5 years. So we had a tax law change not quite 3 years ago now. We've got an election coming up. So there's a pretty good possibility that we're going to have changes to the tax system in the next couple of years. Even the tax law we're currently under right now is set to expire in 2025. So we know we've got some tax changes coming down the road. And the problem is, if you were in retirement for 5 years, tax law changes didn't have a big impact on you. But if you're going to be in retirement for 25 or 30 years, we're going to see, 4 to 5 to 6 tax law changes during retirement. So you could go from having a very high tax rate to a low tax rate, or vice versa. Everybody always thought, oh, when I retire, I'm going to be in a lower tax bracket. Not necessarily the case. Your tax rates are going to fluctuate, and it isn't necessarily true that your tax bracket will go down when you retire. I'm just going to show you briefly the history of tax rates here. So this is from 1950 to 1986. And you can see the lowest tax bracket was in the Reagan years, essentially, at 50%. And they were as high as 92%, and they kind of hovered in the 70s, during a lot of those decades. Since then, we've been in a really low tax environment. If you look at it historically, they got as low as 28% during the end of Reagan and into Bush. And then, they were up to 39.6% before the most recent tax act. And so now we sit at 37%. So if you look at it from a long-term perspective, we're on the low end of the scale. I don't necessarily anticipate the tax rates are going to go back up to the 90% range, but it's not out of the question. And so, we can't make assumptions that you're going to be in a 10 or 15 or 20% tax bracket during retirement. We've got to look at this a little more realistically. So we have to factor in your cash flow planning the impact of taxation. And we like to focus on tax diversification to kind of keep those tax rates as low as we possibly can. So the next risk is inflation. And this is one of those things it's been forgotten about because we haven't really had inflation for almost 20 years. You can see the inflation rate last year was 1.8. It's probably even lower this year, but it can be much higher. On average, it was around 3.5% until the last several years. I can remember when I bought my first home in 1982 or 83. I think my mortgage rate was about 12%. So, we again, 20 or 30 years in retirement, we have to anticipate that we're going to have some inflation again at some point. And so typically what we're doing is when we're working on your financial plan, we're going to assume some spending increases over your life expectancy. We're typically using 2 to 2.5%. But we test for what happens if we have another spike in inflation to see what it does to your financial plan. So we've always got to be cognizant of, what inflation is and what it would do to your retirement plan. When it comes to cash flow planning, if we've locked everything up in like fixed or guaranteed income sources, now we don't have protection from inflation. So just to kind of give you an idea of what inflation looks like, back in 1969, so a little over 50 years ago, this movie, Butch Cassidy and Sundance Kid, was the big hit. It cost $1.20 to go on average. I remember going to the movies, for 50 cents around that time frame, and typically seeing 2 movies. So $1.20 is maybe a little on the high side. But the big movie of last year, The Avengers, the average cost to go see that was, between $9 and $10. So that's an example of inflation. So, if we're going to have, planning in your budget, going to the movies or taking trips and things like that, we have to factor in that those costs are going to go up over your lifetime. The reality is, as you get into your advanced age, even if we have inflation, your spending is going to decline. And oftentimes, you're not going to be driving as much. You're not going to be buying as much, as much in clothing. Your discretionary spending will decline. Not the only thing that will typically continue to increase is your healthcare costs. But we've got to look at inflation as one of those risks, and we have to plan for it in your cash flow plan. The next one is longevity. I mean, this is really kind of the big unknown is we don't know how long you're going to live in retirement. So I've got some numbers here. In 2019, we have roughly 90,500 people that are age 100. And I've broken this down. Ladies, 72,000 of those 90 are females. So by an almost 4-to-1 margin, females live longer than males do. And so, 90,000 out of, I don't know what we have, 300 million people in the U.S. isn't a very big number, really. But this is what it's projected to be in 2054. Now we're talking 600,000 people, age 100. So, we're making guesses on how long you're going to live, and the whole idea of a safe retirement is make sure your money outlasts you and that you don't run out of money. So we've got to factor longevity into the equation in terms of your cash flow planning. So we want to be conservative about that. But are we going to assume everybody's going to live to 100? No, I don't think that's realistic either. We typically are going to have a pretty honest discussion about, what does your longevity look like personally? How's your health? Do you have health issues? Do you have like maybe lifestyle issues like smoking or things like that that may impact your longevity? And then, what's your family history look like? How long did your parents live? Are they still alive? What about brothers and sisters? And so we're typically going to assume you're going to live into your early 90s for the vast majority of people, not 100. But we'll also test for age 100 to see if that's a whole. But what I found in my 30 years of doing this is typically if your money lasts until your 90s, you're not going to run out between 90 and 100. As I mentioned, your spending is going to drop off a cliff in those later years, other than healthcare costs. But we're always going to test for it, and we want to make conservative assumptions. I'm not going to assume someone's going to live to 82, and then at 81 they're almost out of money, and then they live to 90. I mean, we have to be conservative and make sure your money outlasts you. At the same time, we don't want to end up with a big pile of money left over because we made these overly conservative assumptions, and you didn't get to enjoy the retirement that you could have enjoyed because we were too conservative in our assumptions. So that brings us to healthcare. In retirement, particularly in your later years, this is probably going to be your biggest expense. And some of these numbers are kind of scary. This number 280,000, Fidelity, the investment company, and the company we use when we're managing your investments, they're the custodian. Every year they do a study on the average healthcare costs for a typical retiree couple. And that number this year was $280,000. But what that number includes is the cost of your Medicare premiums, your Medicare supplements, all of the things that Medicare doesn't cover, like vision and podiatry and all of that stuff. And then co-pays and deductibles. So it's a big number. Honestly, what I see is that number's probably a little inflated. If you can go out and get a good Medicare supplement, then your costs will probably be more reasonable than that. But unfortunately, the inflation rate on healthcare is 5 or 6%, not less than 1% that we have today. So we do have to factor in a higher inflation rate on healthcare costs. And that number doesn't include the cost of nursing home or home healthcare. That's a totally separate number. And in California, the average nursing home stay is about $7,600 a month, and the average stay is about 3 years. And we're going to actually cover healthcare and elder care and retirement in our next seminar in a couple weeks. So we'll do a deep dive on those topics and how you plan for around those. The other thing when we're dealing with retirees is not everybody's going to retire at 65 when they can collect Medicare. You may retire earlier than that either by choice, or often it's not because you have a choice. It's because you've been job eliminated, or maybe you've had a health issue and you become disabled. So a big part of the planning, before 65 is how do we bridge that gap for these early retirees? Are we going to have to use Covered California? Can we use COBRA for 18 months? Things like that. So a big part of the planning in terms of cash flows, how are we going to pay for your healthcare coverage until Medicare kicks in? And so as I mentioned, we're going to cover that topic in a lot more detail in a couple of weeks. So next, and probably the biggest and most important, is market volatility during what we call the retirement red zone. So when we say the retirement red zone, what we typically mean is about 5 years right before you retire and the 5 years immediately after you retire. This is when you're at the highest risk of a market downturn ruining your nest egg and running out of money. And I'm going to show you an example here where you can see the impact this has. So what we've got for our example here is Bob and Joan have $1 million nest egg. They're taking out $50,000 or 5% to start with inflation increases. So they're increasing that $50,000 each year by inflation. You've got your typical 60-40 balanced portfolio. And we're going to make 3 assumptions. They retire in 1980, they retire in 1990, they retire in 2000, and then how are they looking 10 years into retirement? And when you retire has a huge impact because if you have the misfortune of retiring when there's either market volatility or if there's a spike in inflation, you have what's called sequence of return risk, and your nest egg can be depleted really rapidly. So let me show you an example here. So If Bob and Joan retired in 1980, and they took 50,000 out to start, so over 10 years they pulled out in excess of $500,000. So in the end of 1989, their $1 million nest egg has not gone down. It's actually gone up to $1.7 million. So it's almost doubled in value. And if they retire in 1990, they actually did even better. Not only did they pull out $500,000 plus out of that $1 million portfolio, that portfolio is now worth $1.86 million. But unfortunately, if Bob and Joan retired in the year 2000, not only did they run out of money before the end of the decade, they're in the hole $472,000. Why is that? It's what we call sequence of return risk. And so what you have is, if you're pulling your money out and the market's going down, you're pulling more and more money out and the portfolio is going down further and further. So, why did Bob and Joan have such a great retirement from 80 to 99? You can see what the S&P 500 did during that 20-year period. It went up like a rocket ship. And the worst year was 1987. I got into the business in 1986. So just a year before we had the big stock market crash of 87. So that year, the market was down 9.73%. After that, it recovered quickly, and it just went up and up and up and up. Well, if you're down 9.73%, you only need to get an 11% return to get back to even. But then look at what happened when Bob and Joan retired in the year 2000. First, you had the tech crash. So you could see that the account went down in value, and then it recovers, and we get back to even around 2008, and then we have the next crash, the Great Recession. And so it took Bob and Joan 13 years just to get back to their starting point in 2000. That's why they ran out of money, because if the worst return here was 38.49%. So if we take, say, $1,000 and we lose 38%, we're down to $620. And so if we're pulling 5% out. So out of that $1,000, we're pulling $58 out of 1,000. But now, if we still need that same $50, but we're pulling it out of $620 instead of 1,000, now our withdrawal rate's gone up to 8.1%. And then it's more difficult to recover, because if Bob and Joan were down 38%, if they go back up 30%, they haven't recovered all the way. That $1,000 isn't back to $1,000. It's only back to $856. Actually get back to that 1,000, they need to earn 62%. Because if you lose half your money and then you get a return of 50% again, it's 50% on a smaller number. And so the recovery period is that much longer, and you need to get better returns. So this is a perfect example of sequence of return risk. This is what we need to avoid. This is why we have that retirement red zone, is we don't want to have a situation where you're withdrawing money and the market's declining, and so now you're withdrawing a bigger percentage of that portfolio. So how do we avoid this? There's two things we do. One is cash flow planning. So if we know you're going to need money during this retirement red zone, what we have to do that's critically important is to make sure your cash flow needs are not exposed to that market. If we know you're going to need $50,000 for that year, we don't want to have to pull that out of a market that potentially is going down. For example, if you needed $50,000 in March when the market went down dramatically, that has a big impact. And so we want to make sure that your cash flow is not exposed to markets, and that's why we use particular cash flow planning strategies. At the same time, we also use what we call an investment glide path. You may not have heard this term before, but you're familiar with the concept. So, most people, the common thinking is, hey, as I get older, I get a little bit more conservative. Maybe I go from 100% stocks to, when I'm in retirement, I'm essentially 100% in bonds. And that's a glide path. And so you get more conservative as you get older. What we found is that doing that, where you go from 100% aggressive to 100% conservative, that glide path is not sustainable. It was okay when retirements were 5 or 10 years long, because inflation didn't have a huge erosion effect on your nest egg. But now when we're dealing with 20 and 30-year retirements, we have to have some growth in your investment to offset the loss of purchasing power, which means you can't have a glide path that goes from all risk to no risk. You have to balance it. So typically what we're looking at is we may get more conservative during that 10-year retirement red zone period. So we're willing to give up some rate of return during that period in exchange for not subjecting your nest egg to those big retirement losses. Excuse me. So it's more important to have a return of your investment than a return on your investment during that period. And then after that risk is kind of gone, then the glide path gets adjusted so we can be a little bit more aggressive and invest for some growth. And we found through our own experience, in addition to a bunch of academic studies, that works very effectively. So during that retirement red zone, we're going to focus on making sure your cash flow is not subjected to the risk, and we're going to monitor this glide path. The other thing we do is we use what we call our frugal investor philosophy. Scott Spreen, our company founder, came up with this and wrote a book about it 20 years or so ago. And so our philosophy is it's diversification, so cash, stocks, bonds, which is nothing new. But then the investments that we're using for our stock investments are going to be typically a little bit more conservative, because the vast majority of our clients are in this retirement red zone or they're retired. So we focus on dividend-paying stocks that have a long history of paying dividends, and that we have shown dividend growth. And so we focus as much on the dividend-paying benefits of a particular stock as we do the growth benefits. And so we use this philosophy to generate cash flow and hopefully make the portfolio a little bit less volatile. Which brings us to cash flow planning strategies, which is kind of the main purpose of this presentation today. So the idea is we want to generate cash flow strategies that replace that paycheck, provide you the money you need, but at the same time is designed so that you don't run out of money. And there's a bunch of different ways we can go about it. And we're not tied to any one of the particular of these. We essentially use the one that fits best with your individual situation. And honestly, it's not either or for any of these. A lot of times we may combine a couple of these strategies into your cash flow plan. We're going to talk a little bit more in detail about each of these. So you have principal preservation, you have flooring, you have what we call guardrails, and then you have a strategy called asset cycle or bucketing. And so we'll start with strategy one, principal preservation. This is probably one you're probably familiar with, because this is the one that, in the old days with, our parents' retirement, this is kind of what they did. So the idea is you have a nest egg and you essentially just live off the income from that nest egg. You had bonds that paid interest, or when they matured, you took the income from them, or you have CDs that when they mature, you take the income. Maybe you had, dividends from stock. Maybe you have rental real estate income. All of those are what I typically call mailbox money. You're living off the income these investments generate for you, which can be, really effective. You're preserving your principal for legacy purposes or safety or whatever, and you're just living off the income that the portfolio can generate. Well, that worked great until we had this period of low interest rates. One of the benefits of having no inflation is obviously spending is increasing rapidly. The downside is you also can't earn any yield. I mean, you can't get interest from CDs or money markets or bonds right now. So having these low rates require a larger portfolio for this strategy to work. If you need to withdraw 4 or 5% each year, you can't get 4 or 5% income just about anywhere today without taking an excessive amount of risk. Right now, a top quality money market's getting you less than 1%, 0.9%. You go out to 15-year bonds, which are long-term bonds that have a lot of risk associated with them. Your best case is you're getting 2.5%. So it's virtually impossible in today's environment to get you 4 or 5% income without having risk. And so a lot of the times, we're using dividends from stocks to generate that income because we can get 3 and 4% dividends. We can't get that from the fixed income market right now. The other problem is if you're investing this way and you're preserving the principal and you're just living off income, the lack of growth could decrease your purchasing power, particularly if you're going to live a very long period of time. But this is a strategy that we kind of strive to do at first. It just, a lot of times, the reality is we just don't have enough money to work with, or the yields aren't high enough. So principal preservation is kind of a difficult one to accomplish in today's environment. So strategy 2, flooring, is one that we use a lot, and we typically use it in conjunction with the other strategies we're going to talk about. The idea with flooring is if we can create guaranteed sources of income to cover your basic expenses, we're in great shape. And then your discretionary spending, your travel and hobbies and all that, if we can cover those with your portfolio, we've got a pretty safe cash flow situation here. So your guaranteed source of income, for most of you, it's going to be Social Security. That probably is your base floor income. And we'll talk about Social Security a little bit more in a minute. If you're fortunate enough to have a pension, that's a great thing as well. What I've seen is for the people that have Social Security and pensions, and they have a big base of guaranteed income, their probability of success is usually pretty high, as long as we've got something else to provide liquidity and inflation protection. And if you have a pension, we've got to make decisions about how do we create the cash flow or the paycheck from that pension. If you got a lump sum option, do we take the lump sum and invest the money and have more liquidity? Or are we better off taking a single life pension or the joint survivor pension? We've got to analyze all those in relation to your overall cash flow plan to figure out what works best for you. So there's some important decisions. The downside to something like a pension is if you take the guaranteed income, that's great, you can't outlive it. But at the same time, in most cases, not all, but in most cases, you don't have inflation protection. And so over time, that pension benefit is eroded because of the loss of purchasing power. In addition, you don't have liquidity. So yeah, you've got a guaranteed income, but what if you need $50,000 in a few years to repair the home or do modifications to age in place and things like that? You don't have any liquidity. And that's why it's not as simple a decision as just taking the pension. But typically what we're doing with flooring is we're combining it with the other strategies. The idea is that we can build up as big a solid a base of guaranteed income as we can, then we can make your money last, because all we have to cover with cash flow exposed to markets are your non-essential expenses, which you have control over. So then the next one is spending guardrails. The idea here is, okay, maybe you have Social Security as a floor, but that's not typically going to cover all of your expenses. And so in that case, we're going to have to spend some of your portfolio. And we have what we call the 4% rule, which is kind of a rule of thumb. It was derived by an academic who came up with this simple thought is, what's the safest withdrawal rate that I can have for a typical 65-year-old couple that's going to live 25 plus years in retirement and adjust it for inflation every year, but not run out of money. So it's not guaranteed, but you have a high probability of not running out of money. And when the tests were originally done, it came out to around 4%. Some people will bump it up to 5% using what we call spending guardrails. So the idea here is we're going to take 4 or 5% out of your portfolio every single year, regardless of what the markets are doing. So if the markets are up, we're taking 4% of a larger amount. If the markets are down, we're taking 4% of a smaller amount. Typically, and then we'll place spending constraints on there. So if we have a big drop like we had in March, then we know that we're going to reduce our spending during this time frame. And so each guardrail will be specific to your particular situation, but it may be, hey, if the market drops 10%, we're going to adjust your spending 5%. So we're going to have to tighten the belt for a little bit, not permanently, but for a period of time. And then when the market recovers, then we'll take off the guardrails and you'll get back to your normal spending. And we found by adding these guardrails in conjunction with something like a 4 or 5% rule, your probability of success is pretty high. Now, it doesn't leave the same kind of legacy as principal preservation does, but at the same time, it's probably a more realistic way to go. So, we'll use total return, and we'll just withdraw a percentage of your portfolio every single year, and we'll adjust your spending up or down based on some spending constraints that we come up with, and we adjust them constantly. So with this strategy, we really need to probably meet more often and evaluate your situation, where your portfolio is, what your cash flow needs are. So this requires a little bit more monitoring and guidance than maybe some of the others, but it can be a absolutely reliable source of cash flow during retirement. And then kind of the last one is what we call bucketing or asset cycle. And so the idea here is, each portion of your portfolio has a various role, or you can look at it like various buckets that we assign. So you typically have your immediate bucket, kind of where your monthly paycheck's going to come from your investments. So that's typically that's 1 to maybe 2 years of cash flow needs from the immediate bucket. And then so as you're depleting the cash flow bucket, you have a midterm bucket, which is growing and generating income that we use to replenish your immediate income bucket as it gets depleted. Then you have a long-term bucket, which is used over a longer period of time to replenish your midterm bucket. And finally, you may have a growth or legacy bucket where this is money we're probably never going to touch. So that's where we would invest for growth, because we know that money is not going to be needed for a long period of time, and we can subject it to market risk. So kind of the way this works is you got your immediate income bucket, and again, each of these are custom tailored to your needs. We figure out, okay, this is how much we need to have in your income bucket, and it could, for some people it's 6 months, some people it's a year, some people it's 2 years. A lot of it depends on your comfort level and the ability to take risk and things like that. The midterm bucket probably has things like bonds and CDs, or maybe something like a 3-year buffer annuity that matures, and so then those replenish the cash bucket. And then your longer term investments are going to be your balanced portfolio, where you're going to have those dividend paying stocks, and the income from those dividend paying stocks can be used to replenish your midterm bucket. And then finally, you have your growth legacy bucket. And so, we're looking at your portfolio overall as one big pot of money, but a lot of people are very comfortable with the idea of segmenting or mentally accounting for their investments in these various buckets. And so this is a strategy we'll use if this is one that resonates with you and you feel comfortable using. So those are kind of the cash flow strategy. I said we can mix and match them. And we're not tied to one particular one. There are firms out there that, it's maybe a little bit more cookie cutter. There's like, everybody's just going to get this one portfolio and we're going to use the 4% withdrawal rate or something like that. We absolutely customize that to your individual situation. And so, that requires us going through a complete financial plan with you to do that. But then there are other things we can do as well. For example, getting the most from your Social Security. When do we turn it on? Do we turn it on early? Do we turn it on late? Do we spend your retirement plan money first and hang on to Social Security, or vice versa? So we'll talk about that. And then tax diversification. If we can get you more money because we're paying less in tax, that's just increasing your cash flow, and that's less money that we have to withdraw from your investments. Minter, we focus really heavily on tax planning because, you know, it's not what you keep, it's what you make, or it's what you keep, not what you make that counts. And then finally, we'll just talk briefly about if we have to tap into your home equity to generate the cash flow you need, what are your various options for doing that? So maximizing your Social Security benefits, you know, a couple things to know about Social Security. A, it's guaranteed by the U.S. government. So yeah, it's probably going to be your floor, and you don't have to worry about not getting your Social Security check. Guaranteed by the government, and they're payable for life, so you can't outlive your Social Security check. And they also have a cost of living rate. So unlike your pensions, they have a cost of living rate. So if we have 10% inflation, because Social Security is tied to an index, you're going to get a 10% raise. We haven't had large raises in the last few years because we haven't had inflation. But that's why, you know, this is kind of the best base floor, is because it will keep pace with inflation. It is guaranteed for life, and you don't have to worry about not getting your check because it's guaranteed by the government. What you also need to know, though, is there's a bunch of options for claiming Social Security. There's a bunch of different ages that you can claim it, and there's consequences to those decisions. And so we're going to just kind of quickly walk through the Social Security claiming decision to get a better idea how it works. So we use Bob and Joan as our case study again. They're 66. Bob gets $2,500 a month from Social Security. Joan receives $1,250. So to combine, they're getting $3,750. So that's about $45,000 in Social Security benefits. And again, that increases each year with a cost of living index. So then let's look at Joan and Bob's Social Security as if it were an asset. It was one of those buckets. So how much would we need to have sitting in an IRA or a 401k or an investment account to throw off $45,000 per year guaranteed for life with cost of living raises? So, you know, do they need $500,000? Do they need $750,000? Do they need $1 million? Well, if we take that 4% rule that we just talked about, so, you know, we're gonna withdraw 4% per year adjusted for inflation. How much do they need to have sitting in some kind of investment account to do that with any kind of probability of success? And again, it wouldn't be guaranteed like Social Security would. They need to have, you know, $1,125,000 sitting there to have a pretty good chance that they could sustain that $45,000 for life with inflation guarantees. So, you know, the point I'm trying to make here is you've got a very large asset. You've got to make the right decision with it. So how do you determine your Social Security benefit? The starting point is what's called your PIA, or primary insurance amount at full retirement age. And so what you have here is it's based on your earnings history. And full retirement age is between 66 and 67, depending on the year you were born. So they look at how much you made over your working history, and they come up with, this is the amount of money you're entitled to based on your retirement age, and that's your primary insurance amount. And then they state it as a monthly benefit. But really what it is, it's the dollar amount they expect to pay you over your lifetime. And so what they do is they take it and they start with that full retirement age. And if you haven't done this, you can go to ssa.gov and pull your Social Security statement, and it gives you the value of your benefits at full retirement age. And then it also gives you the value at the earliest payment age, which is 62, and then it gives you the value at the latest payment age 70. And so the way this works is you could take Social Security as early as age 62. If you do that, they're going to reduce your benefits by 25 to 30%, depending on your full retirement age. And this makes a lot of sense because they've calculated how much they owe you, and they're going to pay it over a set period of time. Well, if you're going to take it 4 or 5 years earlier, then they're not paying you any more money. They're just going to spread the payments out over a longer period of time. Therefore, your benefits are going to be reduced. The way to kind of look at this is like a 30-year mortgage. When you have a 30-year mortgage, your payment is lower because you're paying it back over 30 years. Well, they're doing the same thing here. If your life expectancy is 25, but they're going to pay you over 29 years, your benefits reduced. On the other hand, if you delay taking your benefits beyond full retirement age, for every year you delay up to age 70, they give you an 8% increase in your benefit. Well, why? It's the same thing. They're not paying you any more money, but now they're actually paying it over a shorter period of time. So your payment goes up. This is like having a 15-year mortgage. You're paying it over 15 years, your payment's going to be higher than if you're paying it over a 30-year period. This works exactly the same way, just in reverse. So you can take your Social Security benefits anywhere between 62 and 70, and your benefits will be as low as 70% of that primary insurance amount or as high as 132% of your primary insurance amount. So now the question is, well, when should I take it? What's the best option for me? There's a couple things to look at. So if we go back to Bob and Joan, we know that what he's supposed to get is $2,500 a month at full retirement age. He takes it at 62, they're going to reduce his benefit to $1,875. And it'll still go up with cost of living, but it will never change other than cost of living. On the other hand, if Bob waits till 70, his benefit's $3,300 a month. And so, you've got a broad range here. So what's the right answer? Should I take $1,875, but take it for the extra 4 years? Or should I wait till 70 and get $3,300 because I know I'm going to live a long time and I'll get those extra benefits for longer than the Social Security Administration thinks I'm going to. So we can factor all that in. But the other thing we have to factor in is if you're going to take benefits early, what you have to take into account is if you're working still, they're going to reduce your Social Security benefits. And so what they do is if you're working, they're going to take away $1 for every $2 you earn above this threshold, which this year was $17,640. Once you get to full retirement age, then you can work as much as you want and they don't reduce your benefits. But kind of the moral of the story here is if you think you're going to turn on benefits early, but you're going to keep working, you're not going to see the benefits you think you're going to. For example, Bob's getting $2,500 a month at age 65, so he's under full retirement age. And so his benefit's $30,000. But let's say Bob has some kind of consulting gig. He started his own little consulting business, and he earns $50,000 doing that. Well, he's earned well above the threshold, that $17,600 threshold, and so they're going to reduce his benefit by $16,180. $1 for every $2 he earned above the threshold. So he's not going to get $30,000. He's going to get $13,820. Maybe that's okay, but for a lot of people, this is kind of one of those gotchas that they didn't know about. So we have to have a pretty detailed discussion about if we're going to turn on Social Security early, are we going to work and how much are we going to make and whether it makes sense to do this or not. On the other hand, we can look at, okay, does it make more sense to turn it on later and get the benefit of those increased payments? Well, the question there is, how long are you going to live? Because there is a break-even point. And so we can do this break-even analysis for you and determine when it makes sense. And so I've given you an example here. So the green line is someone who takes their Social Security at 62. The blue line is taking it when they're supposed to at full retirement age. And then the red line is taking it at 70. So you can see it's flat from 62 to 70, and then they turn on their benefits. Well, kind of the crossover point where you get more money by delaying Social Security is around 78 to 80. And if we assume that this person lived out to a rough life expectancy of 86 years old, you can see with the red line, by delaying till 70, they actually received $673,000 worth of benefits over that period of time. Versus if they took it early, yeah, they got 4 more years, but it was reduced benefits. They only netted $585,000. So you can see delaying can make a huge difference in terms of the benefit. In this example, it's almost $100,000 difference. And then if you're married, it's even more complicated because now we have 2 people who can turn on Social Security. And so in this situation, the green line is they both take it early. The red line is One of them takes it at the earliest, and one of them takes it at the latest. And this is a strategy that we actually see works very well for most situations. And then finally, the blue line is both of them wait till 70. And you can see in this scenario, the red line works the best. So a lot of times what we see is if you've got one spouse who maybe has the lower Social Security benefit and they're not working, we turn theirs on at 62 or whatever age they stop working. And then the one who's going to have the higher Social Security benefit, we delay theirs until age 70. And again, you can see you're going to get more Social Security benefits by doing that. So this is one way to look at it. But the other thing you got to take into consideration is, okay, great, I'm going to delay Social Security till 70, but what if I want to retire at 63? What am I going to live off of for 7 years? So in that situation, okay, now what are we going to live off of? Are we going to spend your retirement plans early and then spend less of them when you turn on Social Security? Sometimes that makes a lot of sense. Other times it doesn't work at all. We're better off having that floor of Social Security, even if it's a reduced benefit, and preserving, the IRA or the retirement plans of the other investments. So again, it's going to depend on your individual situation as to what scenario works best. If we delay it and use what we call a bridging strategy, where we're going to spend other money prior to turning on Social Security, or are we better off having that floor and turning on Social Security earlier, even if it means you're going to ultimately maybe get less from Social Security, but it's preserving your other assets and letting them grow. So that decision can cost you $100,000 more. So this is one we've got to get right. And so it's definitely an important part of the cash flow plan is figuring out when do we turn on Social Security and what's going to increase your probability of success of not running out of money. But really the real question isn't, do I get more from Social Security? The real question is, how can I make my money last as long as possible? And so the other component of that is coordinating your cash flow along with managing that retirement red zone. So making sure we're not subjecting your nest egg to, market volatility and sequence of return risk. At the same time, coordinating your cash flow. So are we taking Social Security early or delayed? Are we using a bridging strategy if we're delaying Social Security? What cash flow strategy is going to work best for you? Are we going to use bucketing? Are we going to use flooring? Are we going to use guardrails? Are we going to try and do principal preservation or a combination of a couple of these? So coordinating the cash flow. And then the last component is incorporating tax diversification and tax planning into this so that we reduce taxes and increase your cash flow. And so tax diversification is a big part of what we want to do. And like we may use different buckets in terms of cash flow planning, the idea here is we should have different buckets from a tax standpoint as well. We should have money in a tax-free bucket, which would be a Roth IRA or health savings account or muni bonds, or home loans are sources of tax-free income as well. And then your biggest bucket's going to be your tax-deferred bucket. Your IRAs, your 401ks, maybe you have some deferred annuities, things like that. And then finally, you have your taxable bucket, which is probably your brokerage accounts, your stock and bond accounts, your CDs, your cash, and then maybe it's also rental real estate, things like that. So the idea is we want to have money in all of these buckets. And unfortunately, when most people, come to us, it's all in one bucket. It's all in the tax-deferred bucket. And so then we've got to do some tax planning around moving money from that bucket to the others so that we can use tax diversification. So let me just talk briefly about the tax diversification and the attributes of each of these buckets. So we'll start with the retirement plan. So typically when you're putting money in your 401k or your IRA, you're doing it pre-tax. You're either getting a salary deferral in the 401k or you're getting a deductible contribution to your IRA. So the money going in isn't taxed. And then while it's in that vehicle, it's also tax deferred. So you don't pay any tax till you pull the money out. And so then when you take the distributions from your retirement plan, you're going to pay tax at that point because you've avoided tax all of those years. And if you pass away, the government's still going to collect their money. They gave you these tax benefits. They're going to collect their tax from someone. And if they don't collect it from you due to distributions, when you pass away, your beneficiaries pay the tax on those IRA distributions. It's what's called income in respect of a decedent. So someone's going to pay the tax on those distributions. And the trade-off for giving you, a deductible contribution up front is you can't take out the money without a few limitations prior to 59.5 without a 10% penalty. And then they also force you to take the money out. This slide's a little outdated, but the rule just changed from 70.5, you're forced to take your money out, to now 72. So they want to collect their tax. So they're going to force you to start taking the money out and paying tax on those distributions at age 72. And if you don't, they're going to hit you with a 50% penalty on the money you should have taken out. So that's the retirement plan. So that's pre-tax money, kind of what I call, you didn't pay tax on the seed, so they're going to make you pay tax on the fruit. The next bucket is the tax-free bucket, which the poster child for this is the Roth IRA. So with a Roth IRA, the money that you contribute, you don't get a deduction for. So you're using after-tax money going in. Like the regular IRA, it grows tax deferred, but because you've already paid tax on that money, when you go to take it out, it's tax-free. With a couple caveats. For it to be tax-free, you've had to have the Roth for 5 years and you have to be over 59.5. It's still a retirement plan. But you can pull out the money tax-free subject to those two rules. And when you pass away, again, the government collected their tax up front. So your beneficiaries can inherit a Roth IRA income tax-free as well. Another benefit is, again, they've collected their tax. So they don't care if you take the money out or not, because they're not collecting any tax when you do. So you don't have a required minimum distribution from a Roth IRA. But again, the caveat is that for it to be 100% tax-free, you got to be over 59.5, and you had to have had the Roth IRA for 5 years. So with the Roth IRA, you pay tax on the seed, so you don't have to pay tax on the fruit. Now, is one better than the other? Who knows? Because we don't know what tax brackets are going to be. So that's why the idea of having money in both buckets makes a lot of sense. It provides us some flexibility so that, in high tax years, we pull the money from the Roth, and in low tax years, we'll probably pull it from the IRA and preserve the Roth. And finally, you just have your personal investments, your stocks and bonds and things like that. So when you invest money in a personal investment account, that money is also after tax. You don't get a deduction going in. But the difference between this and the retirement plans are it's typically taxed currently. So you have capital gains when you sell an asset. You have interest and dividends that you pay tax on currently. Now, a growth on, say, a stock or a piece of real estate, you don't pay tax on that growth until you actually sell the investment. So you have some tax deferral. And then when you do sell it, you have capital gains treatment, which is taxed at more favorable rates, either 10, 15, or 20%. And then you paid tax on your contribution, so you don't pay tax on your contributions again. So it's after-tax money going in, and it's taxable as you go along. And again, because you've already paid tax as you went along, when you pass away, those assets get what's called a stepped-up cost basis, meaning your kids can inherit that money, that piece of real estate or those stocks, without any capital gains tax. So they can essentially sell those assets right away tax-free. And the trade-offs here, you're not getting any tax benefits for the most part, but it's liquid. So we can tap into this at any time. There are no penalties. There are no required minimum distributions. So again, one's not better than the other. Really, the ideal situation is we have money in all three of those buckets. And so a big part of what we're doing in terms of your retirement planning is working on doing that. So we got money in all these buckets. So that may mean we're trying to do what are called Roth conversions, where we take some of your IRA and convert it to a Roth IRA a little bit each year to start building up money in the Roth IRA. Or maybe it means rather than maxing out your 401k every year or making contributions to your IRA, we might be better off just putting it into a personal investment account so that we got tax diversification in the future. So let me give you an example how this would work. So we're back to Bob and Joan again. So they need $80,000 for their lifestyle needs. They're going to get $45,000 of that from Social Security. That's their floor. So they got a $35,000 shortfall to start. And they have $750,000 in a 401k, and they have $250,000 in a Roth IRA. So what most people would do typically is, okay, we're going to pull the $35,000 from their 401k. As I just talked about, when you pull it from the 401k, now the tax man's coming, and they're going to collect your tax. In addition, what that may do is make your Social Security benefits taxable. Social Security benefits, if you're below certain thresholds, you don't pay tax on your Social Security benefits. But if you're above roughly 25,000 or 32,000, depending on whether you're single or married, now you pay tax on half your Social Security benefits. And the next threshold is, off the top of my head, I think it's 32,000 or 44,000. Now you're going to pay tax on 85% of your Social Security benefits. So by taking this distribution from their 401k, not only are they paying tax on the 401k, now they're paying some tax on their Social Security benefits. So they don't net 80,000. They had to pay tax, so they only netted 72,000. So we didn't accomplish the goal. This isn't the ideal situation. So what would be plan B? Well, let's take it from the Roth. Same Social Security benefits, and we're going to pull the same 35,000, but guess what? The Roth IRA is income tax free. So now we have $80,000 of income, but we don't have any tax because the Roth IRA was tax free, and because now we didn't exceed the threshold for Social Security. Our Social Security benefit is also tax free. But we netted all 80. That's great. That's the ideal situation. What's the problem? At some point, they're going to run out of Roth IRA money because it's the smaller bucket. And then they're going to switch to that 401k bucket. And now they're going to pay more in tax. They're going to have larger required distributions. And so, maybe a better idea would be, as I've kind of been talking about, let's blend these. So same Social Security benefit, but now we're going to take half of the money from the 401k, half the money from the Roth. We have that same $80,000 of income. But guess what? Now we only have $1,300 of tax. So we got them closer toward their $80,000 goal, 78, almost 79,000. And because we're taking only 17.5 from that Roth, that $250,000 Roth will last 10 to 15 years. So we can play this game for a fairly long period of time. And that's why we want to have money in all of those tax diversification buckets so that we can do this. We're going to see your nest egg be depleted much quicker if it's all 100% taxable. And if we have the flexibility to pull from these various buckets as tax rates change, we're going to make your money last a lot longer using tax diversification. So then the last topic I want to talk about before I open it up for any questions is your home in retirement. And for some people, this is your largest asset. A lot of times Social Security is your largest asset. You just don't know it, but your home could be your largest asset. So we've got to make decisions. It's like, okay, do we want to continue living in the home? And if the answer is yes, okay, then the next question is, well, can you? I mean, if it's a two-story house and you're in your 80s, can you really live there? Or is there going to be too much risk involved with that? So can you age in place in your home? Some situations you can. Other situations, it's not feasible. So then we either have to factor in, okay, we got to do modifications to the home, and we have to budget into your cash flow plan making those modifications. Or the reality maybe, at some point you're going to have to sell the house and move into something that you can live in. So selling the house is going to create potentially some cash flow. But if you're going to live in the home, are there ways to tap into that big chunk of home equity and continue living and develop a cash flow plan so that your mortgage is paid off, so down the road you don't have a house payment? And on our website, I just wrote an article on this topic. Is like, which is going to make you feel better, having a paid-for house but not having as much money in the bank, or to have the mortgage but have money in the bank that you can tap into? So some people don't mind being house rich and cash poor if it means that they know they can't lose their house. Other people, it's the exact opposite. I don't want to have all my money tied up into an illiquid asset like a house. I'd rather have the money in the bank. So that's the first analysis we need to do is, okay, what do we do with your mortgage? And obviously, if you're going to sell and downsize, we can eliminate the mortgage. And so if you sell your house, you've got potential tax benefits again. You've got this capital gains exclusion of either 250,000 single or 500 married. So we can sell the house and we can buy something that's smaller, maybe that we can age in place, and maybe that creates a paid for home, or maybe it creates some cash that we can use for cash flow. But if you're not going to sell the house, then how do we tap into that? And so typically that's going to involve taking a loan of some sort. One would be a home equity line of credit. So, the benefit of tapping into a home equity line of credit is that those payments are tax-free because it's a loan. The downside is with a home equity line of credit, you do have to repay that. You're going to have to pay probably interest only for a period of time, and then you're going to have to pay back the principal. And also you have to qualify. So if you're retired and the paychecks have stopped, you may not be able to get a HELOC. So a lot of times this is something we want to have in place pre-retirement while you're still working. And so that's an option for temporary sources of cash, things like that. It is tax-free. The other option, and this is a whole topic unto itself, is maybe using a reverse mortgage. For some people, reverse mortgage has a negative connotation. It's another tool in the toolbox, and honestly, there are a lot of ways you can use them. It is a loan. It is a mortgage. And you can use it in a couple of ways. One is you can tap into that home equity, take that reverse mortgage, and they'll actually pay you cash payments. And so it can be a source of cash flow. There are other ways you can use it. You can actually convert your regular mortgage into a reverse mortgage, so you still have a loan, but you don't have a house payment. And so now your cash flow is increased. Or you can, if you're downsizing, maybe rather than taking all of your proceeds from the sale of your house, you take out a reverse mortgage on the new home for part of it. And again, you have a mortgage but not a payment. So there's a lot of different ways you can use those, and there's pros and cons to it. But it's a tool in the toolbox, just like a HELOC is, just like selling and downsizing is. So we always factor in how can we create cash flow for you if needed from your home equity. And as I mentioned, probably in October, we'll do a presentation on this topic alone. So to kind of wrap this up for you, there are things you can't control in your retirement. We talked about those risks in retirement. You don't know how long you're going to live. You can't control tax changes. They're going to be coming all the time. You can't control inflation, and you can't control health events. Like, are you going to need to go in a nursing home, or you're going to have a lot of healthcare costs? So we try and plan for those as best we can, but we can't control them. What we can control is your spending and your expenses. So if we use something like guardrails, we'll control your spending as needed. You can't control whether we're using tax diversification or not. We can, create those additional buckets and do Roth conversions and things like that. We can control the effect of inflation by investing for growth and trying to not do cash flow strategies that, will cause erosion of purchasing power. You control how much risk you take in your portfolio. And then, making the right decisions about taxation and about what to do with your house and what to do with Social Security. So there are things you can do. And, if you're doing these things, then we're doing savvy cash flow planning. So kind of putting it all together for you, ideally, we're starting this well before retirement. And that gives us the best chance to put together, a really good plan for you. But we have to minimize that volatility during that retirement red zone. We really need to have tax diversification. We've got to make a smart decision about when to turn on your Social Security benefits. And then we've got to plan for those risks. So, it's like one giant puzzle. And for each person, it's very specific to their individual situation. So this is something that really can't be cookie cutter. You've got to work with someone who knows what they're doing here and that can, customize this to you. So how do we help you? We do customize retirement cash flow planning. I mean, the vast majority of our clients are right there at or in retirement. And so this is what we do all day, every day. We customize their cash flow plan. We use our frugal investment philosophy. We integrate tax planning into everything we do, up to and including doing your tax returns. And we're going to look at all the tools in the toolbox. So we have access to all of them. And we're going to analyze them and see, does it make sense for you? And, we're always acting as a fiduciary. So if we're recommending, hey, take this pension option or turn on Social Security at this time or consider doing a reverse mortgage, we're recommending these things because it's what's best for you, not because it's going to make us more money. We're always acting as a fiduciary. We don't have these conflicts of interest. And this is what we do. This is our area of specialization. So if you're already working with us, we're probably doing these things for you. If we haven't done this for you yet, we encourage you to reach out and let's start doing it. And if you're someone who's new to Anchor Bay, we suggest you give us a call and come in for a complimentary consultation.